Good morning, students. We are going to start the today's test session now.
Good morning, sir.
Good morning. We are going to start the session today. We have been discussing entire syllabus now. Basically, we have come to the final syllabus topic today. But I must tell you, we have completed 99% of your syllabus now, right? So, this is your syllabus for the investment banking subject. Right? This is a syllabus. Now, evolution of investment banking, of course, the old question, old syllabus topic. I have given you 12 subject questions and answers to you, which is available on your website. So, with that, basically we have covered this evolution part. This is only a theory part. There is no question raised after 2014, but recently there have one question, but with the common sense you can answer. Only thing, if you have not received this particular one, I will again upload it this afternoon. 12 questions and 12 answers. So basically it covers the entire syllabus. That is the model paper given for this subject. Other syllabus topic also it covers. Basically we are more focusing on the evolution part, which is a theory part of the syllabus. Right now, if you don't receive it, I will again upload it, the 12 questions and answers, so which is very easy for you to go through. And again, then the issue management, we have discussed all the relevant topic under issue management, debenture, and the shares, treasury bill, treasury bonds, and how these treasury bills and treasury bonds are valid, and what are the differences between debenture and treasury bond and corporate bond. What are the markets these bonds are, these instruments are issued? Money market, capital market, then the commodity market, forward exchange market, derivative markets. All these markets we have touched according to syllabus, right? Money market we discussed little in depth. Capital market also we discussed in detail. Forward market we have discussed, but the commodity market and derivative market we have not that much discussed, right? We touched only the examiner, and the syllabus contents are not that much weighted, right? So important topic is in your syllabus is this is one of them. So that every time examiner tests question on this area, he can ask direct questions, or he can relate it to the question to this subject topic. So he can give you a text type question, and he can make relevant to this topic to that particular question. For example, if you take question number 6, 7, 8 in your exam paper, essay type questions. But all these questions are based on, most questions are based on this topic. Most of them. You take interest rate. Are you issuing floating rate? Are you issuing fixed rate? Share issue. Is it worthwhile for you to issue shares? Is it worthwhile for you to issue debentures? All these things, all these questions are basically based on this syllabus. So we have comprehensively covered, and also remember we have learned the required rate of return. Under required rate of return, we have separately discussed how the cost of equity is being calculated. Now, if the issuer side it's a cost of equity, but the investor side it's a required rate of return. Remember that the individual, if the individual wants to invest in a treasury bond, his required rate of return is what? Alternative investment opportunities return. If I invest in this particular treasury bond, Without investing in this particular treasury bond, I would have earned by investing in FD. So if you want to invest in treasury bond, so what is the return you need? At least you need something more than the FD rate. So that is your individual required rate of return. But if you come to company, it is cost of capital. Same thing, but it's the name change. Cost of capital. Cost of capital comprises of cost of equity and cost of debt. So the cost of equity, how did you find out? Dividend, model and capital. Then the cost of debt, that's a separate formula given. What's the special feature there? Tax advantage. Right? So then the entire thing, if you take it together, that is back. Weighted average cost of capital. This time recent papers examiner tested that. Weighted average cost of capital. So the important weightage is represented by this issue management. So basically, if you take investment banking division, one of their main role is this issuing shares. Some company comes and asking you, I need money, I would like to issue shares. So then you undertake it. You undertake. Somebody comes and asks you, I want to be listed. Please make me listed. So the unlisted company, you make it listed. So you undertake it as investment bankers. So all those things are important. Listing requirement, which board you going to be listed, how do you design, what are the listing requirements for main board, what are the listing requirements for D07 board. You have to take. And share issue is the only method for you to raise funds. You can ask that question. Why you can ask, why don't you issue debenture? When you issue shares, your shareholding percentage is diluted. Would you like to dilute your shareholding percentage? If it is an existing company, right issue. The bonus issue we have discussed. Subdivision. So when you invest in shares, you get what? Dividend. Scrip dividend. We have discussed the terms. Rather than paying in cash, you pay in shares dividend. That is scrip dividend. Okay? Then the bond, how the treasury bill market is working. How the treasury bond market is working. What is the mechanism central bank applying? Who can be participated at the auction? Treasury bill, treasury bonds are auction based. Who can be participated at this auction? It's primary dealers. We have 10 primary dealers at the moment. There are banks, there are non-banks. So what is primary market? Primary market is central bank and the primary dealers. So what is secondary market? So we actually, when we want to buy a share, when you want to buy, individual want to buy debenture treasury bond, that is secondary market. We deal with primary dealers. So we have done this. And what is the relationship not tested? Price and the yield. The negative relationship only for the 2-mark question examiner has tested like this. If you are holding government security percentage, would you like interest rate to go up or would you like interest rate to come down? Can be a question. Why? Since there is a negative relationship, you like interest rate to come down, then the price goes up. You can sell at a higher. We have discussed par value, discount, right? And the premium. Treasury bill valuation is a straightforward 100 divided by 1 plus R divided by 364 into D, number of days. Straightforward. You always take the remaining maturity period, not the entire one. The treasury bill is always at a discounted price. should be below 100. You can't have 100, you can't have more than 100. Has to be anyway discounted. But treasury bonds, not like that. Treasury bond, you can have premium, discount, and par even if it's a fresh issue. Now, for example, when your bank issue a debenture, it is 100, not previously issued. Same category, not previously issued. If it is previously issued, then at a discount or premium. If it is a previously issued one, then we have calculated, remember the accrued interest. If it is not at par, there will be accrued interest as well. Dirty price, clean price, accrued interest, remember? Dirty price minus clean price, accrued interest. Accrued interest is what? From the last coupon date to the settlement date. Who is the owner? Who has the right to claim it? The seller. But it is embedded in the selling price. The entire profit will be credited to the new buyer, which is wrong, which is not ethical. So the seller also should get a kind of holding percentage return. So that will be embedded in, that will be the part of the selling price. Then everybody is satisfied. All right. The treasury bill valuation is straightforward, but treasury bond valuation not straightforward. It is basically cash flow basis. What are the cash flows we have taken? Only the coupon and the last year maturity date. Maturity amount, face value. Face value. So what is the discounting rate? How do we find out the discounting rate for a company? Either dividend growth, either dividend model, it can be constant, it can be growth, or CAPM. Do you discount it? How do you decide the period of the coupon? Frequency of the coupon payment. For example, if the coupon is paid semi-annually, remaining maturity period is 2 years, then how many periods you have to take it? 4 periods. Each 1 year, 2. Why? Semi-annual means 2 6 months. If the interest is, if the coupon is paid monthly, remaining maturity period is 2 months, 2 years, then 24 months. For a year, 24 period. 2 years, then 20, for a year, 12, 24, then 2 years. So all these things we have discussed. So important thing. So the individual can be passed away at this option. Yes, if you have more than 5 million rupees, you can pass away. Option is weighted average. That's why you get odd numbers. So every Wednesday you have option, treasury bill, treasury bond of course on the frequent, right? There will be no weekly treasury bond option. Treasury bill rate is what? Risk-free rate. There is no default risk, but other risks are there. We have discussed. Risk-free rate. For the CAPM, we take risk-free rate is as treasury bill or treasury bond rate. They have treasury bond bill is a tradable instrument. You can trade it, you can sell it, you can buy it. How do you buy it? Either through broker or online. Both the things you can be applied. Two-way quotes we have discussed. When you discuss the foreign exchange transaction, buying and selling rate, bid and ask, that is rupee value or whatever the foreign currency value. But in terms of government securities, we have discussed only the percentage, buying, selling, not the rupee value, but the percentage only we discussed. That is the system prevailing in Sri Lanka. Government securities, we go by the yield, not by the rupee value. So then you have to convert. You have to convert percentage value to LKR value. Hypothetically, you have to convert. How do you convert? Depending on the purchase price, purchase yield, compared to the present yield, then you can decide. If the yield has gone up, then the price also should come down. Similar. So before you calculating the price, if the examiner asks you whether this can be sold at profit or not, you can be able to answer that question just by looking at the question comparatively purchase yield and the present yield. Yield is yield is different from the coupon. Coupon is anyway you are getting after 6 months or whatever the depending on the interest frequency. But yield is the price going at the market. If you want to sell it, that's the price. That's the percentage. That's the yield. Yield to maturity. So remember, the coupon and the yield to maturity is different. Right? It can be either way. It can be the same. It can be 10%, 10% when the below. But there are two meaning definitions. Right? Yield to maturity is the trading price, trading percentage. If you want to purchase this, if you want to sell this is the price. You're going at the percentage, but you have to convert it into the percentage into the price. The cash flow basis, calculating the pricing. And we have again calculated the important one. So basically we have discussed treasury bill 3612, but we have discussed, I have given the formula for you to calculate if it is more than 1 year. How do you calculate the discounted price? It can be more than 1 year discounted instrument as well, not in Sri Lanka but other countries. But you examine and bring that question into exam. More than I given the formula. 100 divided by 1 plus r to the n, remember? Important question. So how do you calculate the discounting? How do you find out the present value by using discounting factor? Present value. So the examiner is not giving the present value table. We have discussed in the class. This is the easiest method for you to calculate. 1 divided by 1, if it is 10%, 1.1. And the same answer you are keeping on the display of your calculator and divide again 1.1 for the second period. Year 0 is always 1, right? You are finding the, if it is a treasury bond, you are finding the value for the year 0. You don't have year 0 value. Now, if you calculate the project capital here, say purchase a vehicle, purchase a machine, then you can have a year 0 outflow. You go to first spend it. Spend for you to purchase a vehicle or a machine. Then you have year 0. Now you have cash outflow. But bond is not like that. You are finding the now present value for you to buy. Right? So all those things we have discussed. Relevant to the cash, relevant to shares. This is a hot topic these days. This time recent paper examiner has tested many questions on shares. So we expect same scenario, same momentum will be there. Your exam as well is going to be held June. So the same scenario will be applicable. The share market is a fundamental economic indicator for any country. So we have discussed a type of shares. So what are the shares available on the in the share market, CSC, and we have segregated CSC and the SEC. The trading flow, the boards we have discussed. What are the available boards, and what are the available indices we have discussed. What are the sectors available in the share market? Diversified group, hotel group, then the healthcare group we have discussed. What is S&P 20? We have discussed the market capitalization term. Can be tested for 2 marks. And if you are an investor, how do you decide which share you are going to purchase? I think I have uploaded today some investor ratios. The main ratio is price earning ratio, EPS divided by market value divided by EPS. So you basically decide based on that. That is screening formula. Like project appraisal, the screening formula is payback period. How long for you to recover this investment? And similarly, how long for you to take how long will it take for you to recover the investment in shares? How do you decide? Based on the price earning ratio. Based on the price earning ratio. You select the lower one. Why you need to recover finish quickly. Lower the better. The 5-mark question, frequent question. So there are many formulas for you to decide which share is going to be invested. Dividend growth, interest cover, performance, how do you financial performance in this particular company, all those things discussed. Shares under shares, we have discussed share splits and all. These days share splits are happening, it has happened. Now can be a question in your exam, what do you mean by share split? Per share 10, now you convert into 1 share, 1 rupee share. Then you have more number of shares. What's the purpose of having subdivision? More liquidity. Right issue, this time examiner tested. Theoretical exercise price, 5-mark question, tested. After the right issue price, why the share price has come down? Due to the why? More supply. Right issue is for whom? Existing shareholders. Will there be a dilution? Yes, if you don't subscribe, there will be dilution of your shareholding percentage. There are 4 methods, there are 4 options I have given you. If you have entitlement in right issue. We have discussed the methods of being listed in the share market, very important. Please go through the notes, very important. The government is encouraging companies to be listed. There are 4 methods. Listing by introduction, listing by IPO, prospector issue. What is a prospector? IPO, initial public offering. What is the opposition of the initial public offering? Private placement. Shares also can be issued as private placement. Bonds for debenture also can be issued as private placement. In terms of bonds, we have discussed some special features available in these debentures. Remember that convertible option, not tested. Callable option, not tested. If your bank wants to issue, and if your bank decided to issue debenture, if you want to take this amount, the issued amount into the capital, it has to be then what? Convertible debenture. Convertible debenture is what? With the option of converting, to shares. That is convertible. If it is so, then you can take that amount into the capital. So with the state bank, they can't issue this type of debenture. Why? They don't have share capital. The only sole owner is the government. So then what is the instrument? If they want to issue as debentures, tier 1 instrument. We have discussed. AT1. That's the word. AT1 instrument. Recently, the Bank of Ceylon has issued 2 debentures, and the People's Bank is going to be issued AT1 instrument. So what is the special feature there? There is no convertibility to shares. They don't have shares. Then they have included callable option. After a particular period, Issuer is given the right. Now see, I have given this all this. Who has the right to claim? Issuer is given the right to claim, to call. So who will be in trouble? Investor. After 5 years, anytime issuer can be execute this callable option anytime. It can be 6 years, it can be 7 years. Now, 81 instruments which is available for state banks to issue is perpetual bond. What do you mean by that? Now we know debentures. There is a maturity, redeemable debentures. Remember in the class I showed you a debenture I prospected. Redeemable debenture. You can redeem after 1 day. You will, if you are investor, you will receive the face value. But these 81 instruments are perpetual. There is no maturity. No maturity. Sadakal issue invest karot, invest karama tamai. You don't have maturity. Only the return is what? The yield, the coupon. You can sell it, but no maturity. Perpetual, indefinite. There is no definite time. But you can't say the 5 year debenture. No. Private banks issued convertible debenture. Yes, there is a maturity period. But the state banks issued similar one, 81 instrument, which does not have maturity. It's a perpetual. But if it is no maturity, you have to pay more yield for the investor. Why investor is in trouble? We don't know when this instrument is called. Now, generally, we have discussed the callable option. If any debenture has a callable option, if the issuer decided to execute this particular option, why? Why you want to exercise the callable option? You have issued, now say you have issued 12% debenture for 5 years. These are the question examiner test you, right? 5 year question, 12%. Now you are in the second year. Now you are checking the market. You can similar instrument you can issue at 6%. Since you have issued for 5 years, you have to there's an agreement with the investor. You have to pay 5 years, 12%. But if you have included the callable option in this particular instrument, you can call it. Who has the right? Issuer has the right to call it callable option. In this case, why he has called? Due to the interest rate decrease. So generally, apart from the 81, so that is the embedded, that is a special feature anyways it has to be there, callable option. නිකන් බැංකුවක් නිකන් ආයතනයක් debenture issue කරනකොට if you have put this callable option, again you have to pay more while the investor is in trouble. They call, if the issuer calls, exercise the option. But remember, why he has called, why the issuer is exercising this option? Due to the reduction, due to the lower regime of interest rate. 12 ගාන issue කරොත් now you can issue at 6. Why do you want to pay 12 ගාන? You can issue, pay everything, settle everything, you issue new fresh. Very important subject, very important syllabus topic. You have thorough with everything. All those. That is now the structuring of securities is very similar. How do you decide the debenture? What are the requirements you need to comply? What are the documents you need to raise? What is the price? If it is a debenture, what price? I'm sorry, the coupon interest rate. If it is a share issue, what's the price? You decide. Mechanism. There are mechanisms for you to decide pricing as a structure. How do you structure? If it is 5 years, if it is floating or fixed, if it is 10 years or 5 years, so you decide based on what? Remember, we have discussed the yield curve. There are 4 types of yield curve. Interest rate is decided by based on the yield curve. Yield curve is what? Take treasury bill and treasury bond, GAM and treasury bill and treasury bond rate, and you plot it. That's the graph. So generally, when you are issuing a debenture, the benchmark rate is what? Treasury bond. Treasury bond is there is no risk, no default risk. But when your bank issue a debenture, when your financial institution, when your finance company issue a debenture, there is a risk. When you add the treasury bond is more than the debenture. Treasury bond coupon rate is more than the treasury bond rate. Why? What's the difference? Maturity, risk free. Remember, we have discussed the real interest rate plus inflation is the risk free rate for treasury bills. Then you add another part as maturity risk premium for treasury bond rate. So all those things we have discussed. Comprehensively we have discussed. Asset securitization last week we have discussed. Important one. The pooling of risk. SPV we have discussed, originator we have discussed, credit rating agencies we have discussed, bankers we have discussed. All those things are the people who are involved in this securitization paper. So what do you want to have a securitization? Special requirement is to avoid the mismatch. Asset liability mismatch. Cash flow mismatch. The new instrument. Why do you want to learn investment banking division? Structure this securitization paper. There are many asset backed, mortgage backed. I have given a note on this today. Asset backed. Securitization paper. What can be securitized? Car loans, credit card receivables, the leasing, auto loans, and all those things. We can do that. You can securitize it. But in Sri Lanka, we have the popular one is the leasing companies that can securitize it. So underwriting. So basically, underwriting is what? You undertake to subscribe unsubscribed shares. There are 2 methods basically. Underwriting. So in now present days we have not seen this underwriting, but if you are putting underwriting, so then you are giving the market, so giving the third party investors that I have a doubt my share issue or debenture issue will undersubscribe. Underwriter කෙනෙක් ඉන්නවා කියලා කියන්නේ unsubscribe ඒ කියන්නේ මිනිස්සු ගත්තේ නැත්නම් එයා ගන්න. එහෙම බෑකප් ලයින් එක තියාගෙන ගියාම මාකට් එකට අපිට හිතෙනවා මේක ෂුවර් එකටම මිනිස්සු දාන එකක් නැහැ කියලා. But these days we are not seeing that. Instead of we are seeing guarantee. So the coupon is guaranteed by a rated agency, rated bank. Now I have seen, I remember that when the Ceylon Bank issued debentures, Sampath Bank guaranteed the interest coupon like that. Now recently also we have seen when the commercial credit issued debenture, HNB or some bank has guaranteed the coupon rate. So then we have confidence that my coupon will be receive. But will the capital guarantee? No, capital is not guaranteed. The coupon is anyway guaranteed. So then we have a kind of. So then how do you decide invest in particular instrument? You don't know anything about the company. We have learned this, the rating agency. And we have in Sri Lanka we have two rating agencies, ICRA and Fitch. Internationally we have three rating agencies, Fitch, Moody's and S&P. Three rating agencies downgraded Sri Lanka last year. So this time examiner has not tested the impact on interest rate, right? But in this class we have discussed the relationship between interest rate, exchange rate, GDP, everything. Now all those things, economic fundamentals are questions. Now examiner gives you. I wanted to discuss today the 2017 paper. They are also in examiner has given some economic inflation for 3 years, GDP for 3 years, treasury bond rate for 3 years, treasury bill rate for 3 years. Then he is asking several questions. So the interest rate is downward trend in the future. It can badly impact to the exchange. Why? When the interest rates are at high, then the foreigners come to Sri Lanka with dollars. Now the present days where we are seeing investors are not coming for government security investments. They don't come. So there will be an additional depreciation pressure due to the lack of supply of dollar. Right? So I can test you. So the underwriting we don't see it recently. Now we are seeing the guarantee by rated banks. Oh, yeah, rated company, rated banks, whatever coupon interest. And the corporate finance also we have discussed recently. Loan syndication, I have uploaded a note for you. Loan syndication, basically you get together and give loans. Arranging leverage buyout and management buyout on leverage buyout. Management is going to take company's control. Leverage buyout means you purchase a company with mostly the borrowed funds. I have uploaded the note on that. Investment advice. And also investment advice is the brokering. Now when you want to purchase shares, you need advice from the investor broker. He gives advices. Now you do the advising. Investment bank, you do the advising part. And you also doing that advising. Investment banks. So I have given you the board of investment bankers. Okay? Under three categories. Financial brokering also the similar. It can be share brokering, it can be either different one. So when you issue syndicate loans internationally, there can be financial brokering. We call it a book runner. Book runner. The people who are actually the planning. The issue. And in relation to the shares, the brokering is, you know, that when you speak to the broker, then you do it, and also examiner. And these type of questions tested. The 5 mark question, only the literal meaning. Now, in share market, you know, when you buying shares, You have to pay taxes. So altogether, if you consider the tax percentage 1.12%, when you purchase, taxes are added to the price and you have to pay more. When you sell shares, this taxes 1.12% has to be deducted from the selling price. So that was also keeping. Now recently examined the first question, the recent exam paper, the settlement date. The examiner can test you what is the total amount of tax charged by the share selling and share buying. Possible question. Also the CDRs, CDSPs, brokerage, census, and all those things. There are many things. Now in the share market, we are dealing ordinary shares. Can be uh, voting, can be non-voting. Rights also tradable at the CSC. Proprietary trading is what? We have discussed proprietary trading under foreign exchange market. Now, foreign exchange market, the examiner has not tested for some time. So I have feeling that the examiner can test you. I have given you how to calculate the cross rate. Remember, if it is direct, if it is indirect. Remember that I have given you. If it is direct, indirect, how do you do this? Straight and multiply, cross and divide. Easy methods keep in mind. So you can arrive at a cross rate. So the site also you have to keep in mind, buying, selling. Now this is bank code. You want to sell, then the bank has to buy. So you select the bank's buying site. If you are given a quote in the exam, that is not your quote. If you want to sell something, you are selling, but somebody has to buy. This is somebody's quote. If you want to sell, somebody has to buy. Examiner gives you the somebody's quote. What is somebody's position? Buy. You want to sell, that's true. Then you select the buy side, left hand side. And we have discussed the meaning of nostro and vostro. Also, we have discussed some commodity trading. How do you call it gold? How do you call it platinum? All those things. Important go notes and see. If it is gold, we call it XAE. And the commodity market, we have not discussed much. Then we have discussed what derivative products, internal and external. Internal derivative products are not popular. The most popular one is forward exchange contract. Now remember that now when you sitting for the exam, present foreign exchange restrictions hopefully will exist. So basically you will be sitting for at least 2 to 3 months, but I don't think that government will lift this present foreign exchange restrictions. So then be mindful. We have discussed in the class. Please go and watch the previous video. We have discussed the present import restrictions government has put, and also the impact to the exchange. And also remember that we have discussed the term called appreciation and depreciation. Appreciation and depreciation also we have learned. So that is also important for you. And always you have left hand side is equals 1. If you take GBP dollar, then GBP 1 equals how much dollars? To take USD LKR, which is a direct quote, we have learned that as well, direct and indirect quotes. Easy method is Sri Lanka, USD and LKR is direct. I have given you four foreign exchange, the foreign currencies, AUD, New Zealand dollar, GBP and Euro, indirect quotes. How do you arrive to the cross rates also given? Straight and multiply, cross and divide them. Under derivative products, we have discussed forward exchange, options, futures. Those things. Most popular one is forward exchange contract. Today you want to purchase dollars, you have imported a vehicle. Why do you want to enter into a contract, forward exchange contract? To mitigate the exchange risk. Today you take it 180, 191, but the banks give you after 3 months time settlement is 198. Today 195, after 3 months 198. What's the difference? Is premium. That also we have discussed. How do you decide this premium? One is interest rate parity, the other one is interest rate and inflation. Purchasing power parity, interest rate parity. Just the meaning only. You do not to go inside, in depth. No. Premium, how do you decide? Interest rate parity and the purchasing power parity. That's all. That's more than enough for you. What is interest rate parity and how do you calculate? I have uploaded the calculation part as well, but examiner will not test you the calculation part, which is the syllabus topic for the financial market operation. Calculate the forward exchange price. For you, it's not necessary. Right? You are working in investment banking. When the foreigner comes to you and you need to convert in dollars into rupees, then you need to have a kind of knowledge in this. And how do you advise him to mitigate the risk? Is the derivative instrument. That's why we learned that. Option is another alternative instrument for the forward exchange, but which has a special feature which is not there. Forward exchange content option premium. Future is like what? Futures is another derivative instrument like pledge loans. You agree to buy once the harvest is coming. In the swaps, that's what I forgot. That's another instrument is swap, the derivative instrument. It can be currency swap, it can be interest rate swap. Interest rate swap is what? Floating rate converted to fixed, or fixed converted to floating. That is interest rate swap. If the examiner asks you, we will ask you for 2 mark questions only, right? So only the one sentence, literal meaning. Keep in mind, that's enough. Then, yeah. And also I have given you the special features, forward exchange contract and the option, the differences. This is tailor-made, this is standardized, everything. You can't get rid of forward exchange contract like that. I have given. Please go through the notes. Then the mergers and acquisitions, recently we have concluded that subsidiary, what is a subsidiary, what is the associate, what's a normal investment. Then we have learned what is acquisition, what is a merger. Will the existing company will exist if it is a merger? So an acquisition, will the existing companies are existing? How do you decide it? How do you decide to purchase particular company? How do you decide to purchase acquire a company? What's the price? Purchase consideration. How do you calculate the purchase consideration? the independent auditor. Before you purchase a company, you have to do a diagnosis test. How do you call this? Due diligence comprises everything. Diagnosis test. There are steps I have given due diligence test. Purchase price and what are the valuation methods auditors applying to value shares. Net asset basis, free cash flow, replacement cost, everything I have uploaded the note today. Net asset basis is the screening one. Net asset is what? Equity. Equity is what? Share capital plus reserve. When you make continuous losses, do you have equity? Equity is there but minus. Net worth is minus, no value. Mergers and acquisition we have discussed horizontal and vertical. In the vertical we have discussed forward integration and backward integration. Then the mandatory offer, the acquire company percentage, then if it is more than 30%, you have given the balance part as well to acquire. So mandatory. Corporate restructure means what? Corporate restructure is when trouble companies, you make profit. We have discussed the strategies. How do you convert loss-making company into profitable ventures? Then after the restructuring, you have clean balance sheet. You don't have any accumulated losses. That's the intention. And I have given you the note on wealth management. Wealth is comprehensive. Now you have fund management, you have asset management, then you have wealth management. Wealth means comprises everything. Advising as well. Fund management is I have given you money on behalf of me, you manage my fund. You give me a return, that's all. Fund management has uh, now wealth management has a wider meaning compared to the fund management and asset management. Restructuring, capitalization, trouble companies, turn around. So if the examiner asks you the turnaround as a word, you turn around the company. Investment research, that's a research every time you get. Now when you invest in share brokers, when you invest in shares, CSE, so the share brokers, we have 24 share brokers at the moment, and they will send you the research report on companies. They are recommending to buy, sell or hold. මේ ෂෙයාර් එක තියාගන්නද මේ ෂෙයාර් එක ගන්නද මේ ෂෙයාර් එක hold කරන්නද කියලා they are recommending you. That is investment research. Project appraisal also we have discussed, and that is more relevant to the pricing of what? Treasury. More relevant to pricing of treasury bond. Pricing of treasury bond. So basically what happens is when we do this pricing, project appraisal pricing and this pricing has different. This pricing has different. Project appraisal you have year zero outflow, but bond pricing we don't have that. So then the NPV value we have find out. We have found out the NPV, net present value. Net present value. So if the present value is positive, NPV is positive, then you accept the project. If the present value is NPV is negative, you don't accept the project, you reject it. Reject. Right. This is the nutshell of what we have concluded, what we have done for you. Uh, I have uploaded. I have uploaded some notes for you all for the further readings. Corporate restructuring types, and all those things. Just go through merger and acquisition. Everything is here. Reason for merger, I have taken these things. Now these are the types of mergers, horizontal, and also you have vertical, two types of vertical, backward and forward integration as well, right? And also this one I have uploaded for you to give a kind of knowledge on the forward exchange calculation. Don't worry about this. When you're doing some questions, I will be taking some questions, one or two questions. How do you calculate the forward? I don't think that examiner will test you, right? And this is another note for your asset management and wealth management definitions and leverage buyout and all those things. Why we import hostile. We have done this, but I have taken some notes from foreign exams as well. Just go through this. And this is a loan syndication note which I promised you. And just read it, right? Only the literal meaning, right? Nothing else. And you have another terms as well. Just go through this. Then the special note I wanted to give it to examiner had not tested this, but I think that I have a feeling that when the examiner was more concerned about examiner is more concerned about share market, he can test you this. Can test you this. So please go through this. This is the investor ratios which we discussed. Price earning ratio, and the most important ratios: market value, market value divided by market price divided by EPS. Yeah, that is the price earning ratio. How long for you to recover your investment? And this is the valuation techniques which we discussed in Sharma report. Right? When you acquire a company, this is the valuation techniques. Valuation techniques available. Anybody has any question on the syllabus and everything? So I have given you the nutshell of the summary form of revision of what we have done so far. So if you have any questions, any question you have? Right, I thought of doing some questions with you, starting the question paper with you, since you don't have any questions. But remember that I request you to go through the notes and some for future lectures. So I thought of taking some papers with you all, and I'll be finishing this session with one or two sessions with you all, after doing one or two sessions with you all. So please raise any questions if you have. Otherwise, you might lose it, since I know that it's very difficult for you to learn under these circumstances without having the physical appearance and all. But try to learn, right? The exam also will be the similar to what we had previous. Right. If you take the 2017 March question paper, there is a pattern of coming your questions. So I thought of doing the 2017 March paper, and there are selected questions. Uh, Now, with the first question number 10. What are the major types of stock market indices? That is all share and S&P. And same question number 9, they are asking WAC, the formula of WAC. So we have discussed in the class. And what do you mean by bull market and bear market? So those things I will be thinking that there is no necessary for us to do. We have straightforward questions. We have done that question, right? We have done in the class. And question number 2, I think question number 1, if you feel that question number 1 you have any difficult question for us to do, I can take it. For everything we have done this. All these things are, it's now first question is which of the following cannot be called as the death instrument? So the death instrument, the examiner gives you 4 answers: stocks, loans, bonds, commercial paper. Now, stock is not a debt instrument, right? So this straightforward question like that. All those questions are similar to them. Which of the following is not a capital market instrument? The rate of return on bond, the held to maturity, is known as what? So we have done this. Investment banker is primarily not underwriter, fund manager, issue manager, deposit taker. So he does not take deposits. All right. So then the question number 2, we will start with. In the aftermath of the subprime mortgage crisis and ensuing credit crunch, the world of finance is returning to the fundamentals of valuation and critical due diligence for mergers and acquisitions, capital markets, and investment opportunities. So briefly explain the terminology due diligence and explain the importance of due diligence in mergers and acquisition. Now, what do you mean by due diligence? Now we have discussed in the class, right? Due diligence we have discussed in the class. So the due diligence is basically the diagnosis test. Remember diagnosis test. So the diagnosis test means so that you analyze or you get to know all those things about the company. It can be either financial, it can be either non-financial, everything. Why do you want to get to know? Because you are going to acquire. Due diligence is a diagnosis test. So due diligence is a diagnosis test of the particular acquiree, the company, right? So they're asking importance of the due diligence is M&A. Now M&A means what? Mergers and acquisition. Now importance of the due diligence in M&A is what? Basically, you can get all the information on the company. So there will not be any hidden information. So then you can price a company, you can decide the purchase consideration with a good understanding. But you know the company's affairs, you know what's happening in the company. So basically, when you do a due diligence, it's basically independent diagnosis test. So the pricing are reliable, affairs are reliable, everything is reliable. So important thing is do a due diligence with an independent or an independent guy or basically we ask auditors to do due diligence. Explain the valuation method used in M&A. I have given you today valuation method. The net asset base, price earning ratio based, then the replacement cost and earning base, replacement cost, net asset base, free cash flows. Those are the valuation methods, right? Briefly discuss why the companies do M&A. I have given today the note. The economy of scale, reduce the competition. What else? What are the things that you do it? So basically, economy scale means now everybody is competing. Competition is also going to be minimal when you merge, when you acquire. So you are actually now we have 24 uh, brokers, but the market is not that big. Your company now see the bank, how many banks they have? 24 banks. So the one bank deposit is taken by another bank by giving a higher rate. So the same deposit is circulating. There is no new fund coming sometimes, right? So then the one bank deposit taken by other banks giving a high price. So the same deposit is rotating. But when you have more people for a small market, then there is an immense competition. So everybody is losing. දැන් මොකක් හරි පාරයක් දැක්කම එක කඩයක් දාලා තියෙනකොට ඒ කඩේ ළඟම ඒ හා සිමිලර් කඩයක් දානවා තව ළඟ. මෙයාටත් නෑ මෙයාටත් නෑ. So that's the pattern Sri Lanka. That's the pattern of Sri Lanka. You put the similar thing. You also losing, this guy also losing. He doesn't do it something different. Right? Explain, briefly discuss why the company is the mergers, now economic scale, synergy, expansion. Now, for example, Port Malay was acquired by Cargill. That is to have integration, forward and backward integration. So then you reduce the competition and also you can expand. උදාහරණයක් වශයෙන් ගත්තොත් එහෙම දැන් අපි කිරි විකුණනවා නම් අපි කියමු ෆ්‍රෙෂ් මිල්ක් විකුණනවා නම් if we can produce that particular milk, you have what? Backward integration. You're dealing with the supply. You want to sell it to the end user, you are come into an agreement with this. So that is your forward integration. That is to reach to the end user. With the supply, that is backward integration. So the expansion one is good. Right? So explain the difference between horizontal and horizontal means what? Same line of business. Vertical means different line of business. And in attempt to raise funds for financing, question number 3. Why would companies prefer to use long-term debt instruments to capitalize its operations instead of issuing equity? What is the main reason companies issue shares? Companies issue shares, companies issue debt rather than issuing shares. What's the main reason? Dilution. The other one is what? Tax impact. Tax impact also there. Tax benefit also there when issuing debt. So reasons are that why would a company prefer to use long-term debt instruments to capitalize its operation? When you issue shares, your shareholding percentage is diluted. Sometimes you have a threat of acquisition. So you can avoid everything by issuing debt instruments. It's a liability only. One day you have to settle it. That's all. List down the different methods of issuing debt instrument in Sri Lanka. One of the methods we have learned. Debt instrument. So you can ask public to participate. That is one. The other one is what? Private placement. Other one is what? Private placement. So those are the mainly accepted methods for you to issue debt instrument in Sri Lanka. What is the private placement? You basically invite individual or individual company to invest. Public means what? Like IPO, but here in this case we don't say IPO. IPO means you are basically inviting public to, when you are issuing a debenture, normal debenture, you are inviting public to participate, kind of IPO. Now I actually wanted to give you now recent 81 instrument just now I discussed with you. Everybody cannot be participated. Now 81 instrument, everybody cannot be participated. You and I can't, but there are some eligible investors. We call it qualified investors. We call it qualified investors. I have to upload that note for you all. So who are the qualified investors? Individually also can participate provided they have 50 million. 50 million. So then you treat as you be treated as qualified investor. Then you have, if it is a company, then they have 500 million profit. I can exactly coming to mind. There are few that is the requirement for you to become a qualified investor, but there are automatically listed qualified investors are there. But apart from that, if the general normal company to become a qualified investor, that also can be happen. 500 million, 50 million amount you have to put it like that. So then you become a qualified investor. So I'll give you a note on that. I'll be uploading that particular note to you all. The qualified investors. Who are the qualified investors? I'll give you that note. There is a possibility of testing that question. Right? So the insurance company anyway qualified investors. The funds are anyway qualified investors. But the problem comes normal companies how to become a qualified investor. Normal individual how to become qualified investors. Why do they need qualified investors? If there is a AT1 instrument, additional tier 1 instrument, which is going to be issued by state bank, so they need to have qualified investors. Only qualified investors can be participated. Now, particularly when your bank is showing a convertible debenture also, it can limit to qualified investors. Can limit to qualified investors, right? Now, list down the different method area we have done this. Explain the role of underwriter. The company who subscribes to the unsubscribed shares. Right. Now see the next question. Now question number 3, sub question 4. A company plans to go for long-term fundraising in 2018. First quarter. The prevailing interest rate for 5-year government bond is 12.5. And the inflation rate is 6%. Economies are expecting that in 2018, country's budget deficit will come down from 4.8 to 3.6. Budget deficit comes down. And inflation will be at 3.1. Now, first quarter, what is the first quarter inflation? 6%. Now, inflation also to come down during the year end, during the year. Country's corporate tax rate expected to increase from 26 to 35. Now, when the company is making profit, when the environment, when the economy is good for the corporate, they start to make profit. They start to make profit. They start to make profit. That's why the government has increased the tax rate. As an investment bank advised the company whether debt or equity finance is appropriate. As an investment bank advised the company whether debt or equity finance is appropriate. Now when you get this question, some information are irrelevant to you. Now, if you have the tax, if you want to take a tax benefit, obviously your mind should be adjusted. You should go for debt instrument. So the tax rate has increased. When you're issuing a debt instrument, when the tax rate has issued, is it good or bad? It's good for you. Even the tax rate increased when you issue debenture. The cost is treated as financial cost, the finance cost. Before you pay tax, the finance cost has to be deducted. Irrespective of increasing or decreasing tax rate, it is irrelevant to you. Why? You have already deducted. The amount you pay as taxes, even government increases the tax rate, is not going to be material to you. Why? You have already deducted issuing, provided you have issued a debt instrument. You have already deducted the finance cost. But if you don't issue finance cost, if you don't issue the debenture or the debt instrument, say what happens? Then the amount you make as profit, you have to pay more taxes. When you pay more taxes, can you pay dividend to the shareholder? You can't. Why? Dividend is paid profit after tax. Dividend is paid. Dividend is paid profit after tax. So basically, when you issuing a debenture, that is finance cost. So the profit before tax is coming after deducting the finance cost. But with this option, if you decided to go for equity, then you'll have to pay less dividend for the shareholders. When the shareholders get less dividend, they don't happy. They're not happy. They don't like. They don't like. So then basically what happens is, important thing is for you, sure, equity, not equity, but debt exposure. Why? One thing is due to tax benefit you have. And also see the inflation. Inflation is tend to come down. It was 6%, now year end 3.1. When the inflation comes down, what will happen to the interest rate? Also coming down. You can issue, you as a issuer, you can issue at a lower price, lower coupon rate. Now, apart from this, when the inflation comes down, when the inflation comes down, do you see any relationship exchange rate and inflation? Do you see? It is not relevant to this question, but do you see any relationship between any relationship between any relationship between inflation and exchange rate? Do you see? Can anybody say a relationship, any relationship between inflation and the exchange rate? Now, inflation is what? Inflation is increase in the cost of goods and services. Cost of goods and services are increasing. How the cost of good manufacturing costs are increasing. Now, we as an imported oriented country, we basically do more imports than other countries, right? Comparatively, the Japan. Now, Japan is export oriented. We are import oriented country. So, when the inflation is going up, means that is relevant to the imported good as well. So, when you pay more, when the rupee gets depreciated, the pricing of the imported items also go up. When the rupee is depreciated, now the rupee started this year at 186, now it's at 197. Now rupee has gone up, rupee has depreciated. So the price of the goods, imported goods, also gone up. Anything you imported, you have to pay more. Obviously, you have to increase the price. When you increase the price, it tends to inflation. And again, that is the relationship between the rupee depreciation and the inflation. Now, see, domestic inflation, the cost of manufacturing is going up due to whatever the reason, raw material, the imported raw material prices increase, those countries increase. Then your cost of production also increase. So when the cost of production is increased, you have to increase the pricing as well. You want to maintain the same profit margin. Again, the cost of goods increase. Inflation. It can be either, it can be domestic driven, it can be external driven. So there is a relationship between exchange and the inflation as well with these importation prices, right? So the basically when now in this particular question, interest rate to come down in inflation to come down in future, and also the economy, the what you call this, the different budget deficit also tend to come down. So when the budget deficit comes down, it's good for a country, good for country. So the tendency is interest rate to come down, then obviously you can raise funds at a lower cost. So it's better you go for interest rate, what do you call this, debt instrument. So the recommendation is go for debt instrument due to these reasons, right? So any question you have, so we can continue another 2 or 3 sessions with you all before we wind up the classes. So I'll be stopping the class today. If you have any question, please bring it to the class. Otherwise, no point of just listening later to this video. Your intention is to pass this exam, and you have paid to pass this exam. So your bank is expecting you to pass this exam, otherwise you don't have any promotion. So don't skip it. And this is the ideal time. So we have enough and more time. You don't want to spend for traveling. So my request is, I can see some students, their participation is very low. So don't be like that. So you are the cream of this particular country. So uh, don't think that you can do it later. So I have not seen any student asking questions from me, right? So it is quite pathetic that you don't have any questions, because when you study properly, only you can pass this exam. So this is very much a passable exam paper. 46 marks is anyway gettable, but there are people who are failing. So do whatever we do in the class and study hard and pass this exam. Always I'm giving you encouraging words for you to pass this exam, but you have a lot to do. You have a lot to do. If you don't study and just watch the video later, it's not going to work for us. So your question will remain as it is until you sit for the exam. There won't be any result. And I must tell you, there are people who have passed this exam coming for the revision class as well. So it's very, very important. So you go through the subject, what we have done in the class. Right? So go through the notes, start it now. Otherwise, no point of listening to the questions and answers. You don't pass it today. But do it after that also. Just looking at the past papers with the answers. But the mechanism and the methodology of preparation, the calculation sums, you don't have there. And in this particular suggested answer is only suggested answer. The answers are suggested answers. So we can learn. So we just not confined to the questions only. So we learn, we discuss the syllabus, other matters as well out of this question. So that is the important one for you to pass it. So thank you very much. So we will be meeting next week. Thank you.